Moving on, our next panel will talk about private markets and explore what lies ahead. In this panel, we will explore the future landscape of private markets, uncovering emerging trends, investment strategies, and role of alternative assets. Our esteemed panelists will share insights into navigating this dynamic sector. So please join me in welcoming our distinguished speakers who will unravel the complexities of private markets. Please welcome Mr. Prithvi Burgula, DVP Zonal Head South of KFin Tech. Mr. Prithvi, can we have you on stage, please? Ashish Dave, CEO of Mirae Asset Ventures Investments, India. Ms. Lakshmi Iyer, CEO, Investment and Strategy at Kotak Alternate Asset Managers. Round of applause, ladies and gentlemen. And Yagnesh Sanghrajka, Founding Partner and CFO at 100x VC. Mr. Sharad Mittal, Founder and CEO of Arnya RealEstates Fund Advisors. Round of applause, ladies and gentlemen.
Thank you, Namrata, for the introduction. Very good afternoon, all of you. We have a great panel today, a diversified panel with great representation from people from the PE, VC, credit space. So I'm sure I'll be looking forward to a great discussion, and I'm equally sure that you'll have an insightful session here. While the AIF industry has been growing at a phenomenal rate of about 26% in the last 5 years, the largest contributor to the growth has been through the private markets. And it is expected that the private markets are expected to grow at the same pace or even faster. And we have the contributors to this market as the panelists today. So very good afternoon, all of you. With the above context, I'd like to ask each of you to share your views on what kind of fund strategies do you like in the current market environment, and what do you think will attract the investors' money? Into which sectors do you think that a lot of flows are going to come in the private market space? We can start with Lakshmi.
Thanks, Prithvi. Hi, very good afternoon to all of you. So first and foremost, when they say that markets are slaves of earnings, investors are slaves of returns. So wherever there is a return potential, I think you end up seeing a beeline of investors being made towards that. And that was the first part of your question, and in a lighter vein. But I think jokes apart, looks like given where we are from a macro perspective, given that there is a risk appetite which is coming back with a little bit of vengeance, and the fact that the interest rate environment is getting conducive. Incrementally, rates are getting topped out, and you are going to see, you already seeing so many central bankers ease interest rates. I think the risk asset class, which is equities and fixed income, both seem to be kind of propelling. And in that, specifically, there is a clear beeline towards high yield instruments. So wherever you are getting a better value for your buck on the fixed income side, equities, of course, we are seeing as a story unfold. This is, of course, largely in the listed equity space or in the public market space, but we're also seeing traces of private equity pickup. So I think looks like anywhere there is a potential over the next 3 to 5 years from a delta in terms of wealth creation. And I must also add that anywhere there is a potential for any bespoke opportunity, it could be thematic, it could be sectoral. I think some of these are clearly finding favor with investors across domestic and institutional.
Thanks, Lakshmi. Your thoughts, Ashish?
Thanks, Prithvi. See, I'm more of an equity guy, so I don't have any view on debt, unfortunately. But our view is, if you look at how asset classes evolve, right? My parents started investing in land, real estate, then they moved to gold, then they do FD, then they look for equity through mutual funds, then they go for direct stocks. So So what is the next option? Of course, that I don't think anybody over here believes it's crypto, but it definitely will be alternate assets, right? And within which, because that's where the alpha probably is I think, relatively. And also because investors, they've understood these asset classes and they said, okay, now let me deploy it into some newer asset class accordingly, a small part of my portfolio, let me create it this way. So from that sense, equity unlisted remains a very, very interesting thing. But there's still a lot of education that needs to be done because unfortunately what happens is, okay, इस company का IPO जाने वाला है, उसका unlisted share available है, ले लेते. That thing is still also happening, which is where the fund managers come in and they say that don't do this because unlisted equity is not as easy as it sounds. Exiting it is very difficult. It's not as easy. You will get into it, IPO nahi hoga to, right? So all these things is something that, which is where fund managers are educating, regulators are putting in, all mechanisms to say. But that's where we still see there is a lot of value that will be created. And also, if you look, 10 years back, I think everybody over here knows, when FIIs would come in, markets would go up. When FIIs would go out, markets would fall. I don't think we need that. I'm not saying that we don't need FIIs, but I'm just saying the domestic capital has cushioned the markets so much where I think fund managers have a different problem whether to deploy. I think in the next 10, 15 years, we will see that kind of thing also because education about private markets is also improving. Regulations around it is improving. And also there are assets available, right? In fact, the last 15 years, most of the value that has been created is most with foreign money. I think in the next 10, 15 years, we will see domestic capital participate. And the third thing is there is massive financialization of assets happening across the world, across India, where people are saying that, I want to basically move into liquid assets or probably financial assets, right? Because they have understood with all the campaigns, education that, all funds or everybody has done. So I think these three things tell me, I think unlisted equity, private equity, venture, whatever you want to call it, under whatever umbrella, is a space to be in. And also in the last 15 years, there are managers that have emerged, right, who have shown DPIs, who have shown track record, who have, themes, when it comes to thematic, let's say AI-focused funds. There are certain small shops which are setting up AI-focused funds. We are focused on consumer and fintech of financial services. There are some who are on growth. So there are interesting products coming which may appeal to a set of investors. And I think, so that's a theme that we are seeing, right? Only institutions in India need to warm up to that. That has not happened. Pension funds need to warm up. Because once that starts happening, I think we will see larger funds and capital flow into it.
Thank you, Ashish. Sharad, you are a real estate focused fund. So we know the sector already. But what kind of strategy do you think will attract more money?
Yeah, so just to continue from what Lakshmi was saying, we are in the middle of our fundraise and some of the pointers to share is one, where money is coming, and the second is where money ideally should be also get allocated. So when we are meeting investors, one thing is for sure that the perception around risk is significantly low. So any kind of equity, whether it is listed or unlisted, attracts large amounts of capital. It's operating at a significant scale. The other category where investors have a lot of interest is private credit. High yield is one category which is attracting a lot of capital, rightly so, because there is a lot of opportunities on that side. I would say within the real estate has seen a very turbulent cycle between 2012 and 20. Real estate saw a very turbulent cycle. There are very few managers in India. In fact, you can count it on your fingers. It will not cross 10. But within the real estate, I would say that because the cycle has turned, and real estate by nature is a cyclical business, so it's turned a couple of years back. I would say given the interest rate environment, I would say REITs, rental makes very good sense. We are kind of peak of the interest rate cycle, and rental assets, the private credit can also be played through real estate. Given that we are in upcycle, the risk reward is in favor of doing private credit through real estate. it's not getting very large allocation because of the cycle that was there. An investor look, and probably rightly, they look what happened to them during 2010 to 20. But these are the two places that I would see. Of course, there are a lot of proxies to play real estate through capital markets, but I would say anything related to equities, because the risk perception is extremely low, and this kind of a momentum, I have no clue whether it will continue or not continue. I'm not an expert on that. And the private credit. These are two categories where the bulk of the money is coming.
Thanks, Sharad. You brought up REITs and InvITs. I'll come back to you on that in some time. So from where Ashish had mentioned about the kind of exits, so I have a question for Yagnesh. So what are the kind of challenges a PE or a VC fund typically faces in terms of exiting portfolio companies? And how do you overcome these challenges?
Okay. First of all, thanks for having me. So for those who don't know, 100x, we are a very early stage VC fund. We see things on the ground, right? So when founders start building, is when we catch them young. So that's what we do. And inherently, this is a very risky business, as you can imagine. The mortality rate is pretty high. So are the success and the returns. So it's a little tricky there, but we really enjoy doing this. But just to come to you to kind of answer your question, exits are difficult, as Ashish already pointed out, right? However, what we are seeing is with more influx of capital, and a lot of people are now entering this whole private equity business. They find returns attractive thanks to all the success stories out there, some of them listed as well. So you're seeing, India inherently has been a risk-taking population. If you really see, business guys generally take a lot of risks. And they are the ones who invest in equity markets. And now the whole trend is towards private equity, as we see. And things will go from top to bottom, like higher checks to smaller checks and VCs. So we're seeing a lot of money coming in at the early stage. So the funds that are now setting up, the second wave, as we call it, the startup wave, typically is entering its second phase. Here you would see more investing happening. The exits probably will happen 4 or 5 years from now. Right now, it's actually the phase of investing that's happening. So India today needs more investing than exits, to be honest. That's what will create those exits in the next 5 to 10 years. So you will see some very fancy exits. If the money keeps coming in, as it has already begun in the first half, we've already seen the trend kind of reversing. So the funds really don't need to worry about the exits right now, to be honest. We believe in investing for the long term, so we continue investing in good companies. Exits will follow, right? We all know that private markets, equity, exit is tough, and there are only 2-3 avenues where you can exit. But exit options are always created with more and more success stories. So India needs some of those to kind of happen, right? To create those exits. And it can come from anywhere, like secondary or M&A or listing. It's going to take considerable amount of time. So there really doesn't need to have at the early stage, we really feel we sometimes exit even at a Series B. We come in at seed, we go out at Series A, B, right? We obviously, that's where we've already made our 40-50% IRRs. That's what happens in the early stage VC funds. So I think some of those funds will see very good exits, but it'll take some time.
Thank you, Yagnesh. In fact, you mentioned about a 40-50% IRR. That's quite attractive, and any investor who's into this space would have such kind of an investor return expectation as well. So that brings me to the next question, which talks about growth at all cost. That has been a challenge to the private equity industry and the venture capital industry, of course. So do you see that this is a sustainable way? This question is for both Yagnesh and Ashish, where you can specifically give a response.
See, market goes through cycles, and I think you guys know about this thing. There is a phase of euphoria where everybody's like, there is no end to it. It will keep going up, cross the roof. And then there is a phase where like, nahi, ye to itna niche jayega, zameen ke andar dhas jayega. So there are phases, okay? When there is capital available at almost 0% interest rate, right? People felt that, boss, no, there's so much of capital available, spend. And suddenly when the rates go up, suddenly that capital is no longer available. So, and that's where all the ecosystems go through these multiple cycles. So we had that phase, We don't have that phase right now, but that'll come back again. It often happens in financial markets, we go through these cycles. So currently we are in a phase where no growth, not at all costs, right? And it's a function of what the cost of capital is, right? But it'll come back, right? And that's where, momentum players definitely lose their pants in this period or the period that follows. And the one which focus really on the fundamental investing, and they'll set out of those crazy periods or do limited investments in those crazy periods, tend to survive more. But it's not wrong that, what this phase is, because it's a correction phase. It's almost like, you go to a party, you drink so much, and you say, I won't drink now. But then there will be, another party where you'll go and you'll drink, and it's a repeat cycle. Coming to this piece about growth at all costs, market has a very fundamental way of correcting things. You want to get listed over there, you cannot survive in this manner. And the true test for all the private companies is public markets. Because you walk into a board meeting and I tell the founder, ye nahi chalega, nothing will happen because there is no price action. But that is not the case in public markets. There is price action if you miss a number, right? Profitability is key. Everything from that particular perspective, this strategy is not a good strategy, and also from a fundamental perspective of what corporates are supposed to be. A corporate by definition is supposed to create cash flow, right? If it is not creating cash flow, I don't understand what the reason of it is. The dispute can be whether you create profit in the first 2 years, 3 years, 5 years, 6 years. But I know this argument that Amazon created profit after 17 years of listing, etc. See, that's a corner case. And people don't build businesses on corner cases. And this is actually, as I said, right, this is a good thing that, market is automatically correcting these things. But growth at all costs, at least at this point in time, on certain categories, certain areas, it will still be there. Like I would still say in AI, probably, this phenomena is there a little bit. But it'll correct over a period of time because market will fix it. The invisible hand of market we talk about will fix it, is what we see. But we don't see it anytime soon.
Yagnesh, your thoughts?
So, I have a slightly different take here. I mean, not different. I'll add another angle to it, maybe, So India was actually lucky or, in that sense that the so-called correction, the funding winter, was not that long. It's kind of short. By 22 mid, we were in that winter, right? And then we are in probably summer of 24, or just ending. So it's 2 years, 2-year cycle. And most founders who were smart enough kind of played with their cash flows to make sure they survive. Because there was this whole downturn in valuations which was happening, and the smart guys didn't want to obviously raise in that because they already raised some money. They kind of cut down cost and all of that happened. So I think we're lucky in that sense. The correction is kind of over, and I was saying this somewhere in early 24 that, let the elections be over and you will really see the kind of optimism coming back. So that is, of course, a cycle that will happen. But to say this that, the markets will continue to kind of give these cycles to you. Profitability has always been important. I mean, that question of yours it's a very clear answer, right? Growth at all cost is a no. But like in our stage where we come in, growth is always important because you obviously have to show growth to be able to even show that I'll make profits, let's say in the 3rd year. And we invest when the company's just started and the product is out and early traction. We don't have that luxury of asking, acha profit kab banayega, right? So we have to believe in the founder and the story and the market opportunity and the product to be able to keep funding them to a stage where they have access to substantial funds. So I think that's a question which is very relevant at a later stage. I mean, we are probably not that affected with that question. So,
thank you, Yagnesh. Lakshmi, we talk about asset allocation in the investment management industry. There is allocation which needs to be done to the public markets and private markets in the current scenario. So what is the ideal asset allocation for an informed investor? Maybe it could be a family office or it could be an individual investor towards the public markets. And, within public markets, what should be the asset allocation amongst the strategies?
So, the answer to that is not a cookie cutter answer. The answer to that lies in 2 things. One is what kind of risk you are willing to take. I think that's the foremost, critical when you are planning an asset allocation. And second most important thing is that what kind of liquidity you are willing to compromise upon. It could be a private equity fund or it could be a sovereign gold bond. Both have, lock-ins, and therefore the exit is virtually impossible. And therein lies the third element, which is the return element. So if I am willing to compromise on liquidity and take that delta of additional risk, what is the kind of return I am going to get compensated? So we all know this, that if equities continue to deliver the way they are, the broader markets end up delivering 12 to 13% compounded over the next 3 to 5 years. And post-tax, tax is 10% as we speak right now on long term. If you are going to make thereabouts very similar kind of returns, what should be that delta? I think that is what is determining asset allocation incrementally with the informed investors. Having said that, I must really tell you that the penchant for, a lot of these domestic institutions, foreign institutions, or even family offices, the more savvier family offices are incrementally looking to diversify their asset base out of public markets towards private markets. I think that's a trend which is clearly visible. In fact, some of the institutions that we chat with, they actually tell us that they may not be existing LPs, but they're very happy to do co-investment opportunities, which the platform is probably doing a due diligence and very happy to offer it. And this could be very surprisingly even in the very early stage, not necessarily the mature companies where there is a visibility of IPOing in the next maybe 2, 3, 4 years, but even where you know that the potential for earning a multiple on your invested capital could be maybe 4x, 5x or 6x, where that delta could be relatively lower. So I think some of these are very interesting trends that we are seeing specifically in the last 3 years and getting more entrenched in the last 12 to 18 months. And our sense is that this proliferation, given that supply is meeting demand, we believe that this is a durable trend. And as they always say, buyers beware. So yes, you have to do your due diligence apart from the platform doing the due diligence. But I think it's a happy space currently to coexist.
Thank you. In fact, you mentioned about the supply and the demand. There is an interesting report which I came across, and I'll ask everyone your views on that particular report. I'll come back to Sharad on the REITs and InvITs piece which you had brought up. REITs and InvITs have become popular and are a competing offering to real estate focused credit funds. They also have a certain tax advantage and at the same time offer liquidity. So how do you think your products could be more investor friendly compared to a REIT or InvIT?
So I would disagree that REIT and InvITs are getting too much of space. In fact, I would say there is a fair bit of education which is required with the investors on the benefits of REITs and InvITs both. REITs are very different from InvITs. There is no terminal value in InvITs, and REITs have a terminal value, so they needs to be seen differently. But if I have to see that first REIT came in 2017, I think the participation of retail investor is extremely low given the benefits that product gives. It's at a stage where mutual funds were in, I would say, in 2005-06, because it's a very powerful product. Effectively, it's a product which sits between debt and equity. And to propel the growth of this, the regulator and the tax department has put out various benefits. So one is, I guess, is the only product where is complete pass-through and the tax benefit on the dividend is there. It can be sold on a click of a button and you're playing a real estate cycle. I think there is some more time before they get really popular. To your second question, how do they stack up to a private credit? I would say the risk return profile is very different between a REIT and a private equity fund or AIF real estate fund. Primarily in India, and there are 4 or 5 of fund houses which do this, is largely credit-backed real estate. There, the return profile and the risk profile is different. In a REIT, typically you would look to, given the interest rate cycle is high, probably you can have a yield compression and could look to make 12 to 14% kind of a return. Wherein private credit real estate would look for an absolute return which is closer to 20%. So there are pros and cons of both. What I've typically seen is when the investors look at private equity fund doing credit, they want to sit at the extreme higher end of the return. They really don't want to. So I think the investor profile and the risk return profile is very different. But I would still say that there is the education around REIT and is extremely low for the benefits the product offers.
So all of them, both of them can coexist, and you would want both of them to do
They're
well.
actually not competing at all.
Okay.
They're not competing at all. One, yes.
No, sorry, continue. No, in fact, Prithvi, I must tell you that in our real estate fund, we also own REITs. So it's a complementing strategy, and it's not really a substitution, because look at the number of listed REITs in India. From where it started off to where it is today, it's still not really seen the light of the day. We may see more, of course, in the listed space, but I think it's absolutely we're talking about complementing strategies, not substitution.
Yeah. Just to give a perspective on the numbers here, so that the total amount of early stage capital required for real estate, where banks and NBFCs cannot participate because of the regulatory restriction, for the last year was 1.25 lakh crore. All the private equity funds put together is able to deploy 8 to 10,000 crore. And there are total 5 such funds. So demand supply there is in favor of capital provider. Wherein the REIT, the underlying assets are completed assets by and large, say 80% by regulation are completed, and the return profile is rental income and the appreciation on that. So there are very different asset class. Within the same asset class, different return profile and the risk profile.
So in fact, even EPFO was urging provident funds, exempt provident funds, and the Ministry of Labour, Ministry of Finance had proposed that the investments come into REITs and also into...
And just to add there, there is a new regulation which has come by SEBI, because the current 3 REITs and the 3 commercial REITs and 1 retail REITs are large REITs. So regulation for SME REITs have come, wherein the current large REITs probably have flexibilities to put under construction properties, put lands also. Wherein a SME REIT would be very simple product, where the entire AUM is on rental bearing. So for the investors, it will become easier that whatever money they are putting in, they'll get monthly rental. The whole asset has to be rented. There cannot be anything under construction. And I understand, including us, couple of people who have been working on it, and hopefully next year onwards, you would have simpler REITs. Large REITs also give the same benefit, but a simplified asset form of a rental income played through small REIT could be a good asset class.
Thank you. While I was just mentioning about the report that I had gone through, it talks about the reduction in the deal value and also the money being deployed in the private equity markets vis-a-vis the kind of fundraise which is happening. The fall is to the tune of about 30% in terms of deployment, whereas the funds have been raising 40 to 50% higher than their previous vintage. So will that leave a lot of dry powder, which will be ready to be deployed in suitable opportunities, or will it just create an excess supply, too much cash for deployment?
Okay, so let me go first, and then Ashish can add. So I feel this is smart money we're talking about, right? So typically funds understand this much earlier than other guys, and the reason why you see a lot of dry powder that's been gathering in funds and commitments is actually a sign of things to come, right? When people want to invest in India, that's not a no-brainer, but obviously when and how is important, right? People wait for the right time as much as they can to and now that the uncertainty is over in terms of elections, we are looking at, right now no major event for the next, let's say 1 year, 2 years to happen unless there's something else in the global scenario. But in India, we're not really expecting too many surprises. So the dry powder has been building for a while, and also, by the way, another data point is that VCs have been hiring. I'll tell you about my space. VCs have been hiring a lot in the last year, especially in the year where they were not deploying, which means that they need that team and evaluation and the whole bandwidth to invest when they want to really invest. So those are small signs that you can make from where that right people are getting ready to deploy their funds, invest, and this dry powder is not just sitting there, right? LPs are going to question the fund managers. So at some point they will have to deploy, and that deployment will now begin and probably accelerate because founders have also become quite smarter than before. So you will see smart founders getting funded, and that's the whole trend that we will see now. I hope that answers your question.
Yeah.
Ashish,
Anyone
you wanna
else would like to add thoughts on this point?
See, so one is, see, if you compare, like with last year, of course there is a fall. But if you look at the secular trend over the 5 year, just because that was an, anomaly, एक साल में इतना बढ़ गया, तो थोड़ा mean reversion होता है, नीचे आएगा. And also because, as I said, interest rate, and, overall slowdown in terms of funding. So that's to address. Secular trend is still positive. The second thing is you open the global map and see as a sovereign where can you invest. Russia you will not invest. China you will not invest. The sovereign, let's say Middle East. Middle East is actually, they're pumping money out of it to sort of invest everywhere else. Europe again, it's something not growing the way someone would want to, right? Of course they are going to take private equity bets, but not again growing fast. See, India remains a very strong candidate which can absorb capital. The question is, can you absorb that amount of capital? In real estate, in debt, in venture, in private equity, in 20 other things, this country has the ability to absorb capital. Also, economic stability, political stability, all these things matter a lot. Because you look at Latin America, there is something issue that's on the political side, on the geopolitics side, or something, someone is defaulting somewhere. Or look at Southeast Asia. Southeast Asia is huge. But suddenly you have 20 geopolitical risks because someone is left, someone is right, someone is center. You don't know. So you're not operating in one, versus India is a homogeneous, like one country, one politics, one policy, economic policy, etc. Everything that way one. So capital will continue to come. Right? So secular trend remain. Now the other question about large funds. See, large fund at this point in time, if you ask me, in India is a still private market is a very shallow market. With just $2 billion, you can flood the growth market in India. Okay? So if there is a $1 billion fund focusing on India investments, very hard to generate the return. And always, you look at it, right? For you, if you have a $2 billion fund, or let's say, some of them, let's say have $3 billion fund, and you invest in India, in the next 10 years, you have to return approximately $10 billion, give or take. Which means, if you assume at an exit aggregate across all portfolio companies, or let's say in one portfolio company, 10% shareholding, okay, which means you have to create market cap of $100 billion, which is like almost half an HDFC bank that you have to create. So, that's where, larger funds are harder to return, at least in the near term. Smaller funds will continue to do really well. And I think, the larger fund phenomena was, I think, some time back. We don't know if that will continue or not continue, but larger fund definitely from a fund management perspective, takes the discipline away because you don't have too many assets to invest in. You will invest in things which you are not supposed to invest, which is a fund drift. It's a style drift, right? So I think sanity will come and they will come back to decent sized funds which suits the economy and sector.
The last 5-6 years have seen a lot of capital which is moving towards ESG-oriented investing. So that's primarily in the public markets. But do you also see an ESG investing phenomena happening in the private markets? Are LPs sensitive to ESG investing in private markets? Your thoughts, Lakshmi, on this?
Well, yes and no, because this side of the world, as I said, when I've been part of the public markets also, where also the consciousness was higher only with certain set of investors, and that too largely the foreign-based investors, not so much in India. Of course, there is this ESG score and tracking, so maybe 5, 6, 7 years back, we never had an ESG analyst. Now we have an ESG analyst. So those kind of changes are definitely happening. But is the lack of ESG compliance or adherence being a showstopper? Well, the answer to that is no. But is the consciousness getting much more enhanced compared to what it was maybe 2 or 3 years back? The answer is yes.
Sharad, there is a specific question on real estate focused funds again. Is it the reluctance of the banks and NBFCs that you already have mentioned leading to the growth of this segment? or is there some organic demand for investing in such strategies?
No, real estate as an asset class is a capital guzzler, and it requires capital at each and every stage. So starting from the stage that you start buying the land, get approvals, prime up the site, and then you have activities of sales, construction, and eventually the home buyer comes in and takes the home loan. By regulation, banks and NBFCs cannot come till a certain stage is achieved. A city like Bombay, 65% of the project cost gets spent before regulatorily bank and NBFCs can come. All other cities, this number is between 25 to 30%. And that the aggregate number of that is that 1.25 lakh crore. I'm talking only about residential on an extremely low base of 4 lakh units which were sold in India last year. 4 lakh units sold in India last year, a total value was 4.5 lakh crore, which will be 1.25% of GDP. This number in 2011 was 4.5 lakh units. So we have completely come through. To answer your question, banks and NBFCs by regulation or by mandate is to take a certain risk. They come at a stage where private equity does not have a play. Private equity typically comes in early and then hands it over to a bank. It's not possible to create a 20% kind of a return if you are going to stay put through the life of the project. So this is complementary. The private equity not only does, most of the domestic private equity has been doing debt, but there has been a lot of global money which has come into India in the last 10 years towards core assets, which is rental assets. That money comes at the stage either to build up those assets, to own those assets. So there is no, actually, all kind of capital is required. Both banks, and banks have been very aggressive. Last 3 years, if you look at some of the large banks, and again, the participation is largely from private banks. PSU banks had so much of struggle. So if you pick up any large 4 or 5 private banks, they've significantly scaled up their exposure to real estate at the right stage.
So the last question for each of you. What are the key risks that LPs or investors should be looking forward to in the private market investing? How do you think they'll be addressed? Ashish first.
Yeah, I think the first risk, in my opinion, is the fund manager risk. No, it's the fund manager risk. I think, you, like every business, you get the entrepreneur right, the return will be right? I think spend enough time doing fund manager diligence. Strategy, will keep changing, right? Because, the market is like this, so this is the strategy. Market may change, so strategy will change. But eventually, the person driving the change is fund manager, right? So fund manager is the more important thing. Fund house bhi itna nahi hai jitna fund manager hai, right? So whether the fund manager incentives are aligned, not aligned. So that is the most important thing to keep in mind because it's an illiquid asset, right? So, and there's opacity, there is no information, etc. So you're relying on whether the fund managers' networks are there or no. So spend enough time only on that piece, nothing else to start with. If one thing you're asking, that's it.
Lakshmi, your thoughts?
So I think underwriting and undercutting, this seems to be the two biggest or the latest trend that we are seeing in this world of investments where underwriting standards are non-negotiable because I think we've all kind of discussed for the last 35-40 minutes that the underlying is illiquid. The time to generate returns on that is going to be more rear-ended than front-ended. So there's not going to be instant gratification. So underwriting standards, the risk management practices are non-negotiable. And that's in general for this, the PVC world. And specific to, of course, valuations do matter. And when you were asking that question about the dry powder and all, I think this world is being governed by Moh and Maya. Moh and Maya. Maya is the fact that there is this hallucination phase that every fund manager is believing that he or she will get things cheaper. and the more for the promoter or the investor is to keep asking and commanding higher valuations. And likewise, in the credit world, undercutting is very rampant because the proliferation of credit funds, you just get up, you get a dream, you want to launch a credit fund and you're launching a credit fund. That's what is happening today. So I think with that kind of a thing, the credit is getting mispriced in a few hours, in a few weeks, and a few months. So I think these are the two key risks that I think every LP should clearly watch out for.
Thank you, Lakshmi. Yagnesh, your thoughts?
Yeah, so, whether you are an investor in a fund or you're investing in a company, I think just to add to Ashish's point, you've got to know who's running it, right? If it's a fund, it's a fund manager. So it's very clear that everything is good for India right now, right? This feels like nothing can go wrong. The only thing that can actually go wrong is the guys whom you're putting your money into, right? Whose hands are you putting the money in? Right? That's very important. So adding to Ashish's point, you should know what you are investing in. Understand yourself first as investors. What kind of risk profile? I mean, people like this whole fancy thing about returns and all that. Everyone thinks they can make money, right? Not everyone can. That's the whole beauty of this investing class. So if you are going to entrust your money, make sure that that person understands. When you're investing in a fund, nowadays, this whole thing, one more thing that I would like to, say here is beware about people who are calling themselves fund managers. There are various ways of managing a fund. You can do a syndicate, you can collaborate some people's money and start investing. Be very clear of whether it's really being management and it's of high quality. I think that is something that people will have to be very cautious about. A lot of funds will emerge, as we were talking earlier, but make sure people have history of managing funds. I think they understand the cycles much better. So again, point is the same, nothing more to add.
I'll say two things. One of the key drawback of a private market is illiquidity. Most of the money, whether it is private credit to VC or private equity, would have tenors between 7 to 12 years. So investor has to be very careful on asset allocation. The way I am seeing right now, people are looking equity as a risk-free. Not only risk-free, when I meet them and say, our debt funds have generated 15-16% return, they say, "Ye to hum to mahine mein karte hain." So, so if you are going to allocate money to private market, private funds, you need to get it right on your asset allocation, because money is 7-12 years. There are benefits also of illiquidity, and I am tell you that private market gives you an opportunity to the investor where the investment return and the investor return is same, because you are locked in. You can't do anything about it. Where in the public market you see it every day. So I think getting asset allocation, because you're getting into illiquid asset, is important. Second and foremost, and this can be seen over a long period of time globally, it's like, I agree with Ashish, it's a fund manager who's going to drive it. Alignment of interest of fund manager, extremely important when you're parting with your money for almost a decade. You should not end up in a situation where one manager is investing, other is managing, and third is, and in India, I think we still have some way to go before we can have the maturity of global private equity or private capital. Investors are still at early stages of how this has to be played.
Thank you, Sharad. Any questions from the audience? Okay.
I think I just add one last bit, one sentence. If you're an investor, first study where you want to invest. I think a lot of research needs to be done even by the investor before they invest. So do that for your own good.
Yeah. So Lakshmi had already mentioned buyer beware. In fact, it was an amazing discussion. Thank you all to the panelists who have joined the discussion today. It was quite insightful for me, and I'm sure the audience would agree with me as well. We have discussed about the trends in the private markets, on where the money might be deployed in the future. We could debunk a few myths about private market investing. We could get some clarity on the real estate focused funds. And most importantly, the private market experts have also clarified that there is dry powder which might come in, but it's not going to just be a lot of cash available in the markets. So I'm sure the money which is invested into private markets is into safe hands. With that, I'll wind up. Thank you so much for giving me this opportunity to moderate the session. Thank you.
Thank you so much to our panelists for that illuminating discussion. I would like to call Mr. Ravi Shashadri to felicitate our esteemed panelists. Thank you, Ravi, and huge round of applause for our esteemed panelists once again. All right, before we move on to our two very, very exciting master classes, and we'll also take a quick 5-minute break, but before that, it's time for our third and final round of quiz questions. May I please have Ms. Rakhi Batija to ask the questions.
Just a few brain teasers again. Let's go with this one. Without me, your financial stories can't proceed. What am I? Guarding every deed? Guarding every deed, that's your cue. A deed is an agreement. You're getting closer. Someone who said trust deed. Without it, none of your agreements can be executed. I think we can give them that. Yes. But whom should we? Now that's a riddle. All of you together. Okay, the answer, let's give another try because what I have is another answer. Stamp paper wo hi hua no. Anyone else? The answer is an authorized signatory. Center's going to tell me these are too difficult questions. Okay. We want to give away some prizes, so let's get on to this one. Easy. What is the invention that enables you to walk through walls? Superb. Door. That's the answer. Please come here. Give me an opportunity to click with you, please.
Can we have a huge round of applause for the winner, please?
Okay, another one. Alexis is a name. Alexis was born on December 31st, but always celebrates her birthday in summer. Why? She lives in the southern hemisphere. Super! Please, can I request you to come here for a picture and a prize? That was quick, Spondita. Thanks.
Congratulations.
And one last one.
Okay.
Thank you. Okay. What has a bottom at the top? I don't think anyone will get this.
Someone at the back wants to answer.
Yes? Sorry? No. That's the horizon where the bottom and the top meet, yeah. But what has a bottom? Let's think of some synonyms of bottom, please. Sorry? Bell bottom, no. Well, the answer is your legs. It has a bottom at the top. That was the day. Thank you.
Thank you, Rakhi. And we'll take a short 2 to 5 minute break. Grab your cups of coffee and tea and please head back right in for the masterclass.